All right, it is time for Jordan's top picks on this edition of Market Call, and we're going to start with GSY Go Easy on the TSX. And it's funny, we were talking in the break when we use the Bloomberg data to crunch some of the metrics investors tend to like. This one checks a lot of boxes on that front. Why is it a top pick for you today?
So anyone who follows me and our firm won't be surprised that I'm talking about Go Easy. This was a day one purchase for me when I started my fund 6 years ago. The company, as you say, John, it does check all the boxes. It's got a very high return on capital. It's one of the only companies in Canada that's grown revenue by 30% over 10 years and grown earnings by 20% over 10 years. Excellent operating results last quarter. Raised their 3-year guidance, raised their dividend, announced that they're expanding into a new vertical, which is the credit card space. So this is an entirely new vertical within non-prime that Go Easy has never been in before. I don't think that's as much of a story for 24 as they'll be testing the product, but that'll be really a story into 25 and 26. Tons of growth runway. The loan book's $3.6 billion. They've guided to $6 billion within the next 3 years, so effectively doubling their business within the next 3 years. This is, to me, one of the preeminent financial stocks in Canada. If I could only own one, it would probably be this one, maybe Propel. If you own those two, I don't think you need to own any other financial stocks in Canada.
All right, well, that is saying something. And let's stay with top picks, because the second one today is Enterprise Group. And this is a pipeline construction oil field maintenance company. Is that?
It's oil field services. It's small. It's a $50 million market cap. I'm really excited about it. Like I was excited about Source last year when I came on the show. I'm finding a lot of value in oil field services right now. And what's interesting about Enterprise is they do, when you think about oil field services, you have technology-enabled companies, think of like a Payson or computer modeling, and then you have product-driven companies that are renting products out. Typically, the product-driven companies would have lower margins and really high capital expenditures, and the tech businesses would have higher margins and lower CapEx. Here's a case of a product-driven company with very sexy margins. I mean, you're talking 50% gross margins for an oilfield services company. It's powered by their power division, and what they do is they rent generators that allow their customers to power their sites with natural gas instead of diesel. So there's a big ESG angle here too. Customers will cut their costs, they'll cut their emissions. The company's growing like crazy. Management owns about 40% of the business. So there's a lot to be excited about here. There's no analyst coverage. Easily 50 to 100% upside, I think, over the next year.
Interesting. And with that smaller market cap, what's some of the homework you have to do in those early stages as you're sort of watching a story that is lesser covered, if you will, or talked about?
Well, no coverage. So you have no analyst estimates to go on. You have to kind of come up with your own estimates. There's no research notes to read. You've got to do a lot of your own work. But that's where you get a lot of the gold in small caps, is finding these names early, identifying the potential, and then slowly, as other investors and brokerage firms start to write research, you're the one holding a big position in the stock when others really start to want it. So that's, if you can hone in and do that like we're doing today with Enterprise Group, that's a real key to making money in small caps.
Okay, and then let's go to the third top pick for this edition of Market Call, Topicus.com. Which I feel like have you fielded any questions on this one before on the show? I can't remember. It's definitely come up a couple times.
This is the first Constellation spinoff. So going back to what I was saying before, Lumen's kind of the baby brother. Topicus would be the big brother. Yeah. But the problem is right now the big brother's not getting a lot of attention. So it trades at probably about 20 to 25% discount to both Constellation and Lumen. For those who aren't familiar, Topicus is effectively the Constellation software of Europe. So this was Constellation's European division that they spun off in 2021. And again, very similar to Constellation. You've got the high margins, the high returns on capital. Topicus just paid a special dividend, which I think some investors might have interpreted as they don't have acquisitions to do. That being said, everything looks great at this company. You're getting it at a real discount to the parent. And I think, I like the whole Constellation ecosystem, but out of the three, this is the cheapest.
All right. And you would be watching for them to, same thing, continue to do deals, acquisitions, that thing. But
yeah, unfortunately, they don't tell you about the smaller deals. You have to find out about those later. But they have a great track record of acquisitions. And again, this is baby Constellation. So I don't think anyone who's familiar with Constellation would have any concerns about owning the stock.
Time now for Barry Schwartz's top picks here on Market Call. Number one today, a well-known name to Canadian investors, Alimentation Couche-Tard, the convenience store giant. It has positions all across much of the world.
Under the Circle K brand.
Yeah.
If you have seen Bill and Ted's Strange, or whatever that movie is, Something Strange is Afoot at the Circle K. So Couche-Tard is in the convenience store business. It owns gas stations. Gas stations bring people in to go shop at the convenience store because they make 30% margins when you buy your candy and your gum and whatever you buy at the stores. This is now a global business, owns, I think, 16,000 gas stations across the globe. There's potential for significant consolidation going forward. These are great. They're just great operators of the store. So we've been watching this stock, Paul, for 20 years. Finally pulled the trigger recently. The stock, I mean, this is a stock that rarely pulls back, but it has pulled back.
Right.
It missed, this is when we talked about earnings, it missed earnings expectations, mostly because of lack of volatility in fuel margins, which is impossible to know, and maybe a little bit of the consumer being hurt by inflation in the U.S., they're buying fewer cigarettes or types of beer or what have you. But long term, great company, high returns on invested capital. The four founders still own 23% of the stock. And, very attractive valuation in our opinion.
Okay. Alimentation Couche-Tard is number one. Number two, also an iconic name in Canadian investing, Restaurant Brands International, QSR, on the TSX, the owner, of course, of Tim Hortons.
Tim Hortons, Burger King, Popeyes, and Firehouse Subs. And still probably at some point another brand to come. But in the short term, the company gave at its investor day guiding for 3% same-store growth over the next 5 years, adding 5% new stores per year, as well as keeping costs low, buying back stock, raising its dividend. It's just an interesting story. The valuation is really attractive compared to McDonald's and its other peers. And the smoking gun, the smoking ace is really Patrick Doyle, the chairman. Patrick Doyle turned around Domino's Pizza, and this is exactly what Burger King is doing. It's in a turnaround mode. He turned around Domino's Pizza to be one of the best performing stocks from 2000 to 2010, killing every other stock performance. He's got a big payday coming his way if that happens at Restaurant Brands. We're very attracted to partner with him.
Is a slowing North American economy a concern for stocks like this, for companies like this?
In the short term, of course. I mean, that's it, and it has a lot of lower end consumers that are obviously feeling the pinch. But this is a global business. We'll get through those short-term issues. The Tim Hortons franchise is doing incredible. Popeyes is doing incredible. Burger King really needs to turn around, but we see great things going forward with Restaurant Brands.
Okay, and the final one, also a well-known name in the energy space, Tourmaline Oil, which I think, despite the name, is primarily a nat gas producer.
That's
correct?
right. Probably close to 80% is natural gas. So I highly recommend that you search out any Mike Rose interviews on BNN Bloomberg. He does a great job of explaining what's going to happen to natural gas going forward, because it's in the dumps right now. Natural gas prices are so low because we had such an incredibly warm winter in North America, and 2/3 of natural gas demand is for heating. I don't know what's going to happen to the weather going forward. That will normalize, of course. But this is a story of the electrification of the grid as well as LNG. We got LNG Canada coming. We have more, hopefully, that are going to be approved in the future. LNG in the U.S. That's going to take natural gas off the market, ship it over to overseas where they need it, really, and reduce higher demand, reduce supply. That should be more firming for natural gas prices. Balance sheet is perfect. Pays special dividends. Mike Rose is a genius. He sold 2 natural gas companies already. I think he's going to make us a lot of money. So we're sidecar investors with one of the best, Mike Rose. And
do you think that the LNG export capacity in Canada, when it finally arrives, will be material to the supply-demand fundamentals of nat gas?
The expectation is it reduces 15% of the supply of natural gas from Canada. Tourmaline doesn't directly benefit from the LNG Canada. It doesn't sell into LNG Canada, but it will benefit all natural gas producers. And if we get a colder winter, Paul, and more demand from electrification, watch out to natural gas.
Top pick number 1, Stryker. This has long been a favorite of yours.
Yeah, so Stryker is a medical medical device company. We really like it. Stryker does kind of back, sort of spines. They do knee replacements, hip replacements. They also do hands and ankles. So when they bought a company called Wright Medical. So this is a great business for a couple of reasons. One, there's a kind of an annuity because people are getting older. Demographics are getting older. People really need these services. That keeps them out of hospital, keeps them out of pain. And so that's one thing. Doctors tend to use the same product constantly. That's the other thing that we think is really important. So you're not switching all the time. So as the population gets older, there's more and more need for this. A lot of their revenue comes to the United States, so there's a great opportunity internationally to grow, especially in the emerging markets area. So that's another thing that we think is really important. And I think that medical devices are really changing the way people can live their life and how long they can live their life for. So I think that's a very important aspect of this company. And I think that there was a huge backlog on a lot of their surgeries were considered elective during COVID. There was a huge backlog. It's sort of being caught up right now. And I think that's when you're going to see, after that, you're going to see some really good legitimate growth. And I think the company's going to continue to do well. And they do a lot of tuck-on acquisitions. So I think that's going to happen, continue to happen as well.
Another favorite, EssilorLuxottica, the eyewear giant.
Yeah, so EssilorLuxottica is made up of two businesses, the eyeglass business, which was Essilor, and then Luxottica was the frame business. And they got to put them together, an Italian company and a French company. You didn't think that would happen, but it did. And so to us, it's a great business. One, they do a lot of, so eyewear has become, it's a fashion statement as well. So there's continually people buying eyewear because of that. Also, we use a lot of screens, and people's, especially young children, eyewear, their need for eyeglasses have gone up a lot over the last several years, and that's continued to happen. And as people get older, obviously, and some people don't like contacts, right? So they want to wear glasses. So that's one thing I think that's really important. They bought a company called Grand Vision, which gave them a huge presence in retail, which I think it's going to change the way the business is done. They own Sunglass Hut, all these other things. And the other part of their business, which is very important, they do a lot of third-party eyewear frames, right? So Prada's frames are made by these guys. Chanel's frames are made by these guys. So, and the other thing is the technology for glasses is very important, and Essilor is the leader in all that stuff. So they're one of the largest players in a very small group of companies, and so I think they're certainly market share leaders in the eyewear frame and on the eyewear glass business.
And then finally, Novo Nordisk, the slimming drug giant.
Yeah, so we've owned it for a long time, but obviously their big business is Ozempic and Wegovy, which are the weight loss drugs. This is a company that is actually started off with insulin was their biggest business. They had other businesses, but insulin was their biggest business. It's funny because this company is owned by the Novo Nordisk Novo Foundation, which owns a large majority of shares. So nobody can really buy out this company, and not like other pharmaceutical companies. And so it has a chance to really develop drugs over a period of time. And we can go on about these weight loss things, but the growth in it is substantial, and it has a lot more runway. And there's only really two companies that are really ahead in this one. One is Novo Nordisk, and the other is Eli Lilly, right? And they've got a massive lead over everybody else. So I think that's really where you're going to see this stuff continue to grow. And I think once they realize that it's not only helping with heart disease, fatty liver, all these other things that it's helping with, there's going to be more and more push to allow people take it before they get sort of type 2 diabetes. And type 2 diabetes is a terrible drug. I mean, terrible disease, right? It takes up about $2 trillion of US money each year because of the ongoing cost of diabetes, right? There's all kinds of things that happen, not only stroke, loss of eyesight, loss of limbs, all kinds of different things. So using something like this that prevents you from getting type 2 diabetes is pretty incredible, and about 70% of the U.S. population is considered kind of overweight or obese, right? So there's a lot of people that can use this thing. So we think there's a lot of runway on this, and I think they've got enough lead that'll keep them ahead of everybody else.
What could go wrong? I mean, ultimately, other companies will come up with
so
drugs.
obviously that's one thing. I mean, one of the issues is that there was a short supply of this stuff, so that's one thing that hurts the company, right? So that's one thing. I think obviously other people will come up. There'll be more competition. There may be some government because of the impact on it from a global perspective of how it will affect kind of healthcare costs. Governments could say, well, we're only going to pay you X dollars for it. So there could be something like that happens that hurts them. But as a general rule, I think that it is showing to have other benefits, right? Not only from on the heart side, fatty liver, less use of alcohol and drug uses. So there's a lot of data coming out over the next I'd say, year to 2 years on this stuff, and it's very impressive what it's doing, right? So I think there's a lot of stuff that is very positive, but there could be these little things that come up, and there's going to be more competition. A lot of people are working on these things, right? So.
Yeah. It's interesting, the food industry trying to react. There is some evidence, apparently, that people eat less junk food.
Yeah, so, I mean, if you were on this thing, you probably eat less McDonald's. You probably continue to eat McDonald's, but you eat less of it. So that's kind of the idea. It's sort of very intuitive what happens. You just eat less food. And if that's the case, you actually lose weight, right?
Welcome back. Time now for top picks from our guest Brian Madden at First Avenue Investment Counsel. Number one on this day, Netflix, ticker symbol NFLX on the New York Stock Exchange.
Certainly a household name, and Paul and I were just talking off the air about favored streaming shows. So streaming is the new normal. Going to movies is the old normal, and Netflix is certainly the clear leader in streaming high-quality video content. And the proof of that is in their 260 million and growing subscriber count. There is a competitive landscape. There's a number of competing streaming platforms, but Netflix has strong pricing power and does maintain best-in-class customer retention. And they're able to do that through pretty aggressive investment into original content. The tailwind recently has been the conversion of password-sharing users to paid subscribers, which they're doing via so-called interventions. They're also going to have a tailwind going forward from digital advertising. They've now rolled out a version of the service where there's a small amount of advertising each hour of content. So with strong scale and expense management, this should enable rapid free cash flow growth, 75% of which they've earmarked for share buybacks. And so we foresee, and the consensus view is that they will be able to compound their earnings at 28% over the coming 3 years. The stock is trading at a discounted valuation relative to its own history, not cheap in the absolute, but trading at 34 times earnings, and that's about 20% below its historic average. So I think it's a good entry point here.
Okay, Netflix trades on the NASDAQ, not on the New York Stock Exchange, as we incorrectly said on a couple of our graphics. Let's go to the next one, Service Corp International, ticker symbol SCI on the New York Stock Exchange.
Yeah, so this one is a little bit more somber. This is North America's leading death care company, the owner and operator of 2,000 plus funeral homes and cemeteries in the United States. And Canada. This is an industry that's very, very fragmented with lots of little mom and pop single site operators. Service Corp is the leading consolidator in the space. They have about a 15 or 16% market share. It's a business where size and scale are a meaningful advantage. Their financial strength is also an important advantage, particularly at a time when their two primary rivals in consolidating the space, who are much smaller, are encountering some financial difficulties and are retrenching. So they earn a 30% return on shareholders' equity and rising. They're lapping a couple of post-COVID years where there were some growth headwinds, difficult comparisons. We expect they should be able to accelerate back towards their historic 14% cadence of earnings and dividend growth. And so we see a good combination of value and high visibility, non-discretionary, non-cyclical growth here. Stock is sort of testing tentatively its all-time highs, and we think it should have an acceleration going forward.
Okay, and finally on this day, the big name in Canada's uranium sector, Cameco, ticker symbol CCO in Toronto.
This is one of the world's largest producers of uranium. It's one of a very small number of public companies. It's essentially a pure play on uranium production. That's, of course, all because 7 of the 10 largest producers are state-owned enterprises, collectively accounting for about 70% of global production. Cameco's got 2 mines in Saskatchewan and a joint venture in Kazakhstan, 485 million pounds of reserves. They should be well positioned to benefit from utilities scrambling to buy fissile material from any stable source, i.e. not Russia. And so uranium markets are very tight. Evidence of that last year was Cameco restarted their McArthur River mine, increased production 76%. Uranium pricing was up 16%. Their earnings were up 134%. They're expected to double again this year and grow another 57% next year. So this is a perfect fit for our momentum portfolio. And you've got a change in the prevailing view on the future of nuclear energy, not just driven by China and India building nuclear reactors, but Canada, the US, Japan, the United States extending reactor lives and even greenlighting some new reactor builds. And finally, the icing on the cake here for Cameco is the acquisition of Westinghouse Electric late last year in partnership with Brookfield Renewable, which brings them downstream integrated into reactor build and maintenance. So great momentum name here that we own in our momentum mandate.
Welcome back. Time now for top picks from Javed Mirza. He's answered your questions. Now he will give his 3 top picks. The first one is a stock we get a lot of calls about, and usually the answers are given from a fundamental point of view. Alimentation Couche-Tard, ATD on the TSX. So we'll get some technical perspective on this stock now. Javed.
Perfect. So what I just want to flag here is we've got this really nice, beautiful uptrend. And the stock right now has pulled back right to that uptrend line, but importantly to a key technical level at the 200-day moving average. So a lot of people are going to view this as important technical support. Now, Paul, at the start of the call, what we talked about was we thought equity markets were going to come under pressure. So this is consumer staples. This is typically one of the more defensive areas in the market. So this is more of our short-term place to hide. So we're not looking for absolute performance, but what we're looking for is relative outperformance. So let's say the TSX is down 3 to 5% in the next 2 months, then maybe this is only down, like 1 or 2%.
Mm-hmm. Okay, number 2, Alamos Gold, a company that, again, we get a fair number of questions on. It's also been in the news quite recently for an acquisition it has made in Northern Ontario, ticker symbol AGI.
Yeah, so in our weekly note, we recently recommended this. I can't remember if it was here or here. The bottom line is we saw the stock start to strengthen. I know in our previous role we had recommended this name just because it had broken out to new highs. But the bottom line is here's the previous resistance level around 20. We cleared it quite easily. This is, as far as I recall, the best looking gold stock in the TSX. So definitely this is a name, if you want to add gold exposure, this is it right here. So up and to the right, this chart looks fantastic, especially for a gold stock.
Okay, there you go. Lots of interest in the gold stocks with the metal itself trading at record highs. Let's go to our final top pick of the day from Javed Mirza today, Finning International, the big seller of Caterpillar earth moving and construction equipment, FTT in Toronto.
Yeah, and this is the beautiful part where fundamentals and technicals align. We talked earlier about Ivanhoe, a top pick by our fundamental analyst, Farouk Hamid. This is a top pick by our fundamental, or not a top pick, but a strong buy by our fundamental analyst, Steve Hansen. So he likes this name. Correlation to copper. This is part of our peanut butter and chocolate plays. So we like materials, we like industrials. These are the industrials that make equipment for miners. So it's that really nice intersection that we call peanut butter and chocolate. So Tormont is a name, Caterpillar in the US, Deere, but this name as well. So it's playing catch up here. And if we're correct on our copper call, that copper is going to break out to new highs, then Finning is very likely to follow suit.
Okay, let's squeeze in one more topic, because you and I chatted about it a couple times off camera. We've got about 60 seconds to look at lumber and tell us what you think of the lumber price.
Yeah, so if we can pull out a very, very long-term chart. So part of the conditions for me coming on board here on Raymond James was my boss said, he's a lumber analyst there. He said, I have to be positive on lumber. But
I'm afraid we can only do 6 months, I've told, on lumber.
So the bottom line or the key takeaway is where we are in the cycle, lumber is very positive. And the last time we recommended lumber in this part of the cycle was 2020. So definitely the potential for appreciation here. It's been really, especially over the last couple of years, come under a lot of pressure. But we see from our cycle work, materials should do well. And it looks really poised to push higher here. So really like lumber, and the lumber stock should benefit from the tailwind of lumber improving.